and then yeah, as you probably remember, Steve, it's quite relaxed. We've got a decent bunch of people, I think. Hopefully won't give you a hard time. Hopefully you get some intelligent questions.
Hopefully we'll give them a hard time, Steve.
No, Steve wants to come on to Playpen to enjoy himself, not to so there you go. But I'll start opening up the lobby, and yeah, if you want to sort of just introduce yourself and present, and then Henry and I will just look at the chat and look at the hands up, and just sort of yeah, just keep going through. And as you remember, Steve, we have a hard stop at 11:30. So really appreciate your time. Really appreciate your time, Steve. Really appreciate your time. Yeah. This is when Henry gets excited. So hang on. Right, here we go. Morning, Peter. Morning, Charles. Morning, David.
Morning, all.
Morning, Con. Morning, William. Morning, Bob. Morning, David.
Morning.
Thank you for joining. Good to see you all. Good morning, Michael. Good morning, Mrs. Bromwich. Maybe.
That's right.
I'm disappearing, I promise you.
Good to see you.
Good to see you. Although I have to say, it's an aging brigade we have today. Our demographic looks decidedly tilted towards longitude.
Steve's not that old.
We're running on. What are you on about?
Running on. Yeah, everybody's running on, you see. That suggests exercise. Morning, Jackie. Thanks for joining. If you've just joined, can you please mute? Actually, Peter, thanks for muting. That's great. Con, thanks. And David, if you could mute as well, that'd be great. Thanks very much. Brilliant. Okay, excellent.
I would say that the video is the thing that really matters. So we're all in the performance, and we get hundreds and hundreds of views of the video.
Yeah, we do. Yeah. Morning, Adrian. Morning, JQ. If you could mute, please, that'd be great. Thanks for joining, Jackie, as well. Great to see you. Okay, brilliant. I think we're sort of there now, and we will monitor the lobby as usual. Welcome everyone to this week's Pension Playpen. Delighted to have Steve Hodder on from LCP. The actual theme of today is run on, but actually it's the super tanker of DB de-risking. Is it changing? Is it moving? And if so, in what direction? Try not to steal any of Steve's thunder. But he has presented before. Some of you may remember May 2023. So, Steve is an experienced presenter on Playpen, and I'm sure he'll be delighted to entertain us all with his thoughts. As usual, we're recording, so thumbs up if everybody's happy to be recorded. Jackie, Bookcon, William, everybody's happy. So the video will be available this afternoon on the Playpen site. And if you want to make any points or notes, then please enter any comments in the chat. Alternatively, as most of you will know, Henry and I like to see a hand raised and you can ask a question. And Steve will be delighted to answer any questions, challenges, agreements or disagreements. So there we go. Steve, without any further ado, thank you in advance. Over to you, and thanks for your time this morning.
Brilliant. Thank you very much, Steve. Yeah, and delighted to be here again. It doesn't feel like 2 and a bit years ago that I was last having this conversation, but equally quite a lot has moved on in 2 and a bit years. I think it was 3 and a bit years where me and colleagues were first thinking about this whole DB policy space, and effectively the challenge we set ourselves was, have we really cracked it? We're helping all these schemes disinvest from any good investments they have and de-return the whole pot, and who's really winning from that? Is it really the right answer, or could the rules of the game be adjusted to lead to a different outcome? So obviously been a fascinating journey for a few years. Lucky to work for a firm, LCP, that had the foresight to employ people like Sir Steve Webb and David Fairs, which has given us lots of ability to not just have these conversations as colleagues down the pub, but also talk to regulators and government about all of this, which has been fascinating. I think two relevant points to frame the discussion. I've advised a number of large schemes now to defer a buyout that they were planning to do on the basis that it can benefit both their members and their sponsors. So very happy to talk about how that works, but equally important to stress that my firm LCP do advise on more buyout transactions than anyone else, and equally, whilst I think run-on works fabulously in the right circumstances, there are plenty of schemes where perhaps they're not big enough, perhaps the covenant isn't strong enough, and consolidating in some way is the right answer too. So we're very much sort of in that position of right answers for different schemes. So I've got some slides. I can talk through those, but equally very happy to be interrupted and take any question or challenge. I like Henry's or Steve's characterization of pleased to interrupt, not just to agree. We were rehearsing for a webinar the other week, and we had about 500 attendees planned, and someone on the feedback call said, well, I'm not sure all of our audience will agree with that statement. And I thought, okay, what's the right level of disagreement? It's not no one out of 500 disagrees, then you've not said anything. So please, in particular, do shout if you've got issue with anything I've said. So with that, shall I share a few slides and just lay out the background, and then maybe we can pause and see how the discussion goes? See if that works. Share screen. Should know how to do this by now.
Yeah, brilliant.
Good. Okay. So here we are. So some questions that were circulated on the agenda, but very happy to cover whatever makes sense to cover. How can these strategies work best for members and sponsor? Crucially, what circumstances do they work? What does it mean for the investment strategy schemes are adopting? And I think perhaps most interestingly, what's the government doing? And is that likely to turn the super tanker? I think that characterization of spending a lot of time thinking about this, the seeing those super tankers come down the Solent and needing to start turning 15 miles before they want to. We've been on a 20-year journey in this industry of de-risk, 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 and that's all we've ever been told. That's all the government's ever said. And all of a sudden, the answers are starting to change. And I think that inertia, that people mindset on some of these decisions is one of the biggest factors at play here. So I think there's three key points I wanted to leave you with. I mean, firstly, I'm a firm believer that in the right circumstances, running on a DB scheme beyond buyout affordability really can benefit everyone. And I'll talk to an example of where that's worked well in practice. I can't stress enough that government and regulator appetite, views, stated position to all of this is shifting drastically. And I'm going to touch on some of the recent TPR guidance that was announced and some choice quotes in that if you read them 5 years ago in advance, you'd think, what on earth has happened here if the regulator is saying this? And I think crucially, many schemes are now at least reassessing their position. I think we've lived through a world of sort of default, almost the utopia of if we could afford to consolidate and get rid of this, then wouldn't we love to? But now that some schemes or many schemes are reaching the point where they can do that, they're at least reassessing whether that's still the right thing for them to do. So I'll just start with a bit of a thought on different stakeholder perspectives on all this. I mean, firstly, with the members, this is one of those AI image generations, and ignore the fact that the poster behind these two pension scheme members says denied benefit, which I think is some sort of tech Freudian slip that's come in here. So hopefully no one's being denied their benefit. But the member perspective on this, from my conversations, I think sort of the advisor community, even the trustee community, who are obviously there to represent the members, we can have a tendency to overcomplicate these things, and we think a lot about fiduciary duty and or X, Y, Z, et cetera. But I think from the member comms I see and people I talk to, often it can be this top left one that dominates the discussion. So I see that the scheme is now very well funded. Can I have some more, please? And a lot of this sort of technical debate about, is that really the proper purpose of the trust or blah, blah, blah. I think lots of members, it can be quite a simple question of, especially when you had a pre-97 world of, we used to get some discretions when the scheme was well funded. That hasn't happened for a very long time. Now I see the position we're in, possibly we can do something. So I think sort of the ability to provide more benefit to members is one clear fundamental potential upside of running on a scheme before its sort of soonest opportunity to consolidate. And then I put dependents pension on there too. I mean, in one of my live cases, the scheme does not provide a dependents pension. It's something that clearly the members and the trustees on behalf of the members would love to be able to provide, and it's something that's becoming possible. So there's sort of real people, real world benefits here that I don't think we should lose sight of. I think on the right hand side, key question one is security, which is an interesting point. And I think there's been plenty of quite lazy characterization of if we consolidate, the members will be more secure or even completely secure, which is a question rather than, I think, a statement of fact. I think the other aspect on security is obviously it depends on the covenant in question. So some of the schemes I work with that have opted out of doing a transaction, they're very strong employers. They're much larger than the scheme. There's sort of good grounds to do an assessment and conclude that the members are as, if not more secure, under that regime than where they might have gone. But for others, it will be completely the other way around, and the ability to go into the insurance regime and the capital and everything behind it will be a vast improvement for security. And just the final thought on security, there's an element of sort of how much benefit you're expected to get, because if through this journey you can uplift the members' benefit from 10 grand to 12 grand, say, even if it is slightly less secure at 12 grand, what's the chances that it's more than 10? That's the question. So I think having that grown-up conversation about what outcome are we looking to get for the members here, what's the right risk appetite, and what's the full fair assessment of the situation. From the sponsor's perspective, again, question one I often get is whose money is this, and can I have it back, please? Because whoever you talk to, you're obviously going to get a biased view, right? But whilst members might look at the situation and think, well, last time it was overfunded, we got some discretion and it's my money, gov. Sponsors, I mean, I work with plenty who would say, hang on a sec, we've got 100 million surplus now. Didn't we put in 100 million of what you call deficit contributions over the past 10 years? So I'm pretty sure I can work out whose cash that is. It turns out with hindsight, you didn't need to ask for that. Obviously, good faith at the time, you thought you needed it, but we accidentally overpaid this thing. So that's our money. So surplus refunds, obviously high up agenda. There are some sponsors who think about improving benefits. And at least maintaining. And I think we're going through a very interesting phase on that side of things now. We're seeing CDC really starting to gather pace, more so than I thought it would, if I'm being honest. Part of that is trying to employ people in a competitive workplace environment. So we've seen sort of various sectors sort of really looking hard at the CDC option. How can we make sure we're providing as good a benefit or better benefit than company PLC over the road? So I think the ability to provide a good benefit to people, whether that's sort of ongoing DB accrual, where that's still the case, or perhaps using a DB surplus to sort of seed a CDC offering, I think is increasingly attractive. We all know we're running into a pension adequacy problem. It's the first point made on any sort of independent review of the pension system. So I think employers are increasingly aligned to that. Accounting is, in my experience, often the biggest driver here. So I think this is where the logic can leave the room, because on the face of it, with some schemes, you can look at the situation and think, well, there's a big pile of cash there that the sponsor could get its hands on and generate more over the years. But often that surplus refund or that use of cash doesn't come through P&L. Whereas if they have to use any surplus to increase members' benefits in some way, that goes down as P&L costs. So depending on how pensions are accounted for, that can be the key driving factor. And some schemes I've discussed this all with have basically formed the view that because of the way we account for the pensions, making money from the pension scheme is a bad thing for us, and therefore it doesn't make sense. So that's a real world driver that often doesn't live in the more theoretical thinking. And then just a final point I'll talk to on this, the shareholder views point. I mean, what a company management think their mandate is here. So I've got one client that is running on quite aggressively. They're investing back into riskier assets. They're a fairly aggressive business in the oil and gas sector. The big part of their day job is investing huge sums of money in a fairly risk-on way. So they feel like they have a mandate from shareholders to maximize the value of anything that the business has. So a large, well-funded scheme, they don't view as a particularly risky endeavor, and something that shareholders would probably want them to look to benefit from. Got another client with defensive private equity owners who it's sort of an infrastructure type business. Their mandate, they think, from their investors is close off risk, focus on the core business, focus on the infrastructure. So they've reached a very different conclusion. They're smart people, they get the opportunity, but they think we don't really have a mandate from our shareholders to look to sort of profit from something that feels a bit non-core. So that can feel really important. 2 slides in the section before I'll pause, but we've started doing this type of modeling for schemes. And basically this is saying, if you've got a scheme, it's a $1 billion scheme, it's fully funded on buyout. So you could just go to the market tomorrow. It's invested in gilts plus 1 and a bit type investment strategy. And every year, if it's generated a surplus above buyout, then you take it out. If it slips back into a deficit on a low dependency measure, then you have to put money back in. So the idea here is sort of looking at this like you might any other corporate project and say, well, what's the potential cash flow of this endeavor, as it were, and how do I feel about it? So this is showing the range, classic stochastic model, and I guess the punchlines are the red line's the average, and the average is positive. Point number 1, of course it is. If the insurance industry want this thing, then it's clearly going to have a positive value. The positive value that accrues year on year does go down, because as the scheme matures, the ability for you to invest properly, in inverted commas, diminishes, but also people get cheaper to insure as they retire. So you've got that factor coming in, and clearly there's quite a big range. So this is not without risk. But if you then do sort of a net present value calculation and say, well, let's pretend for a sec, this isn't a pension scheme, it's a factory we built. It took us a while to build. It cost more than we hoped, but it's now built. It's generating this range of cash flows. What's the value of this endeavor? 100 to 250 million, depending on how you invest the assets. So these are the sort of the slightly dispassionate economic conversations we're trying to have, to say you're in this position, you've got to this position, you wouldn't have chosen to do everything as you've done for 20 years. But now let's take a step back and think about what could you do with this. Now, I'm not saying that it's a decision to just destroy 250 million of value if you hand this off to someone else, but there is a potential here to do something different and look to benefit your stakeholders through the position you've got to. And then final page on that, I think I just saw a question come in about this. How do you share that benefit? And this can become the most politicized question and debate. And I was in a conversation last night with some very large schemes, and they were effectively saying any decision to share this benefit between sponsor and trustee is so hard that we're just not going to do anything. So you've got schemes with very large surpluses, effectively just proactively deciding to not do anything with it because the decision of how to split it is too difficult. If we give anything to the members, they'll want more. If we give anything back to the sponsor, the members will start suing the trustees. It's very, very challenging. I think I used to show a slide, I probably did 2 and a bit years ago, of a pie. Simple analogy. We've got a pie. How do we split it? Members, sponsor, taxman. And the answer of, yeah, it's a bit tricky to work out how to split this, so I'll just put the pie in the bin. No one has any. But it doesn't feel like the right answer. But the reality of the situation I see is in many cases it can just be too hard a question. So I think conversation we were having of I don't know how helpful it is as market norms become established on this question. What's a normal thing to do? What can we point at? Government clearly has stopped short of giving any sort of guidance so far, or making a sort of a set target split of any surplus, because it does depend so much on the situation and the history. But this can be a hugely difficult question. So sorry, numbers on this page show that previous page, central value is 160 million. If you give all of it to the sponsor, clearly their share of the value is 160, and there's a 99% chance they get a positive value. If you share it 50-50 with members, the sponsor's share is a bit under half, because you've got the asymmetry that every time you win, you share it. In the number of scenarios where money has to go back in, it's the sponsor who's picking up the tab. So if you sort of share any surplus 50-50, your expected value share is more than 50 to the members, but the chance of a positive value is still 95 in that model. The thing that gets very interesting is if you start sharing more than 50 of any surplus with members, the sponsor share goes way down. The chance of a positive value is now well under 50%. So no logical sponsor who's making this decision based on sort of economics is saying, yeah, let's run on and give most of it to the members. Now they might do that for other reasons, but from a sort of value share, it's not going to happen. So in practice, we're seeing most of these work that it's a majority share to the sponsor of any surplus. So I'll pause for breath there and hopefully have a few questions to answer.
Yeah, I just would like you to explain what the other arguments might be other than the purely economic one. Why would schemes want to give money to their members in those levels which you see as uneconomic?
Yeah, so I think some of it can be, well, I guess it is economic if it's about retaining good people and hiring good people and you're in a competitive industry and maybe the guys across the road are offering something more generous. So I think sharing someone, but that kind of relies on you having a meaningful active member population, which lots of DB schemes don't. There is in some cases just a sense, and one business I've worked with, I mean, they provide DB benefits globally. They're somewhat cyclical in nature. They have a bit of a company ethos of when the times are good, we do the right thing by our people, and when the times are bad, we sort of ask everyone to tighten their belts a bit. So they sort of came to it as, look, ultimately giving those people who even they might have left us 10 or 15 years ago, but they're feeling a lot poorer in real terms. Is this an opportunity to give them some more pension? Maybe. So yeah, you get some of those, and that might step into maybe this isn't an entirely economic decision, but sort of more of a company sort of policy type approach decision.
Would you include in that example you've just shown giving money to active members as well as the deferred members, and the active members being considered those who are currently getting a, let's say, workplace pension arrangement? So you increase their employer contribution or give them a CDC. And what might the economic advantage, non-economic, the advantages be of doing that? Just a little bit more from you, Steve.
Yeah, so we're seeing plenty of schemes add a DC provision back into the trust so that they can use the surplus to pay for DC. I think in pretty much every case that's basically been to pay the DC that was already being paid. It's just a more efficient way to do it if you can fund it that way, rather than using that as an opportunity to improve the provision. So again, that's effectively a tax efficient way for the sponsor to get the value out, rather than, I mean, part of how this all started was thinking, could this big overfunding of DB schemes be used to improve the pension provision of the current workforce? And we haven't seen lots of that yet. But as I say, in the sort of the CDC context, and I think we are starting to run into some employers in some sectors think, I need to do more here on pension provision. We're going to have the first generation of sort of post DB people retiring over the next 10 or 20 years, and I don't think it's going to look very pretty. And I think we're all starting to wake up to, could more be done? Who does the burden fall on? Is it simply the state who picks up the tab? Is the burden on employers? Again, sort of discussing recently the viability of the state pension continuing, certainly with the triple lock. I mean, there's big questions there, but I think ultimately a lot of employers I work with do sort of draw the conclusion of, not really my problem, Gov. I'm sort of operating within the framework, and I've got to provide the pension that I need to keep people employed. Maybe that's starting to change in terms of how generous that needs to be.
Okay, I'll shut up my questions. I think you've got more to come, Steve.
Yeah, we've got hands raised. Bob, you're the first, and then we'll come to Peter. So, Bob.
Okay. Morning, everybody, and morning, Steve. I just wanted to make a comment about embedded value in pension schemes, and that is Athena have just gone ahead to buy PIC for £5.7 billion. That £5.7 billion is embedded profit coming from buying out pension schemes. And that's profit lost to the sponsors of those pension schemes, basically. And Athena wouldn't be buying for 5.7 billion if they didn't think they could make more money out of running annuities. So that's got to be a fantastic argument for run on for sponsors of larger schemes that have actually got a lot of value. They put a lot of money in through excessive contributions over the last 15, 20 years. They should not want to throw that away to the likes of Athena.
Yeah, it's a good question. I'm glad you used the word larger schemes, because there's an entirely logical point that schemes, I showed the information for £1 billion scheme. If you run those numbers for a £50 million scheme, it shows you a very different answer, because the value it ends up being negative, because
and smaller schemes, Steve, obviously they've got the hassle factor, the governance issues. There is a variation, but larger schemes,
there's a valid point that if 20-50 million schemes run on, they're probably not generating anything, because the economy is a scale point. Whereas if an insurer consolidates those 20 schemes into a billion scheme, or 200 schemes into 10 billion, then they're generating profit from that due to the efficiencies of what they can do. So there's definitely a sort of profit that's not there under the consolidation route. But yeah, completely agree. There's sort of on the economic point, a larger scheme is expected to have a positive value from here. That's why PIC want it. That's why Athena want to buy PIC. But again, you come back to some of those points that I think many corporate sponsors would say, well, yeah, get that, that's fine, but I don't really want to take the pension risk. I'll just take out any surplus I have now, or maybe I don't have the governance time, or the way the accounts work, I just can't profit from that, or I've got to hold loads of bank risk capital against the risk. So there are different factors, but yeah, I completely agree. On the face of it, it's
but with those factors there's surely got to be a case for a consolidator like pension super fund was at one point proposing to share the profits that they're making out of these consolidated schemes on a run-on basis with the membership. And any set of trustees are actually happy to give away the rights of their members to potential bonuses. They've got to be asking some big questions, and there's got to be some big questions in the future. Could there be some class actions against sponsors and trustees that agree to a buyout when maybe future super fund type arrangements are starting to offer much better benefits on a run-on basis with sharing their profits with the membership in future years?
It's an interesting question, because we've lived through 10 years of schemes of all sizes doing buyout transactions and doing a press release, and it's in professional pensions and champagne corks are popping and everything else. And we've seen plenty of cases where a company that had a pensions problem can announce to the market, we've solved the problem, and the share price goes up. And I've had the same thought, Bob, that I don't know how close we are to. I mean, there's a visibility dynamic here, because schemes that are choosing to defer and run on, other than Schroders and Aberdeen, who have maybe a PR reason to advertise what they're doing, they generally happen quietly in the background, so you don't have that same perspective. But yeah, I could definitely see a world where trustees being asked questions from members. Well, my mate who worked for our competitors getting his £5,000 bonus again this year, and where's mine? And now I think trustees today making decisions would feel pretty legally secure if they've thought about everything properly, that they've made a sensible decision, that is supported by guidance and everything else. But yeah, I'd interested to see when we might hit a world of members and shareholders saying, well, hold on a sec, why didn't we look at this as an alternative?
And Steve, I'm going to make one other comment. A colleague of mine used to be a member of a very large pension scheme, where that pension scheme used to give pension increases every year all the way up to the mid 80s into the early 90s. That was bought out probably about 15 years ago to a large pension scheme. The ownership of the pension scheme, the buyout annuities, was moved and transferred to effectively an organization which is overseas controlled. So they've not only given up discretionary pension increases to the pensioners, but the quality of the ownership of the provider of the pension annuities is now less controllable by the UK PRA than was previously the case. The pensioners had no say in this whatsoever. So the control of ownership of their annuities has moved. And that was another factor which I don't think people are actually considering at this point.
Yeah, absolutely. And a lot of time when schemes do these transactions is spent on assessing the counterparty and how they manage ESG risks and quality of the admin and everything else. And yeah, there's definitely a recognition that you can assess that, but it's then out of your control as the trustee what happens 5 or 10 years down the line. I think for balance, I'd say that there are many schemes with pretty bad administration, and members may see an improvement, even if that then gets sold on to someone else. So
Yeah, agreed.
I think
Agreed.
it can work both way rounds, but it's definitely a feature that there's a loss of control there.
Yeah, but these are things that I've not really thought about, I think, in the typical decision to buy out. Normally, it's been a finance director pushing to get the pension scheme off the books. And I think that time is changing, which is good news that it is changing.
Yeah.
Thank you.
We've got some more questions, but Peter, I think you've got your hand up. Do you want to have a go?
Yes, thank you. Just in case Steve or anybody else, and thank you, Steve, for an excellent presentation so far, and look forward to it continuing. I should explain that I've been chairing a trustee board of a shared ambition DB pension scheme for the last 20 years, which has obviously gone through the same processes as everybody else. But now we're into surplus. We are sharing the surplus between the employers in reducing the future contribution rates into the scheme, and the employees in giving revaluations of their pension rights. In the last 2 years, we've given 10% per annum revaluation. The situation is the company is quite happy sitting with a large asset on its balance sheet because it's not subject to any of the conflicting rules. It also gets the income from the surplus recorded in its profit and loss account, and the situation is that the surplus generates even more surplus going forward, which is the run-on position you're talking about. When I start expanding this out, I sort of wonder, the biggest downside is the administration costs of the scheme, of a smaller scheme. As you've hinted, this is the most factor on scale and why consolidation. But equally, if they consolidate out of the company to save the administration costs or reduce them proportionately, the company then loses a share of its return, if you like, from the scheme. Now, if the company was to use it to pay DC contributions, those DC contributions are entirely dead money to the company. It hits the profit and loss account and the cash value, and the value to it in terms of recruitment and retention of even a generous DC contribution has diminished substantially over the last few years, with all the press comments about your pension scheme's not going to give you what you expect and all the risks that you've got to face. So they are actually finding some of these, like employers have, and I don't know whether this is anecdotal, are losing mature employees to particularly the public sector, because they're saying, oh, we can get 15 years of a DB pension before we have to retire. We'll do that, and sorry if you're not giving us a DB pension, we're going. And they're even taking salary cuts. So I really think that probably the most efficient from the employer's point of view is to use the surplus to provide future DB pension benefits, and to continue to grow the assets, to grow the returns and grow the capacity for surplus in the future. Now, I'm having some discussions with fairly large companies about this, who are thinking about DC/DB use of surplus as alternatives, and then if it's DB, what should we guarantee, and is shared ambition an appropriate model for the future? So,
Peter, your questions are rather like pension oldies blog comments on my blog.
There might be a reason for that. Yes.
So, I mean, I think it's great that you put it that way. Have you got comments, Steve?
Yeah, I think Yeah, agree that those are lots of live issues that many are thinking about. I think, as ever, what it can come down to with employers is how much they're willing to underwrite that tail event. And I think so much of this boils down to that question, because DC for employers is easy, and they know they pay their money in the year they've made the profit, and then they're done. And it's almost sort of as unlikely as a tail event is, it's there and it's on the books somehow. I can't see a large scale move back to sort of full date DB for that reason. I think there's,
from the employer's point of view,
from the employer's point of view, yeah,
is upward only.
Yeah. So I think
cannot reduce DC contributions once they've established them. The contract.
True. Although I think a sort of an incremental government pushed increase. I mean, there's a lot of talk about whether DC auto enrollment minimum should go from 8 to 12 at some point. It's having increased the NI contributions. I understand that's effectively off the table, and I think Torsten said something recently to that effect, that the stage 2 of the pension review is not going to increase contribution rates on employers. So I think employers are sort of pretty happy to wear the risk with DC that the contribution might go from 8 to 10 in the future, but they've lived through a period where DB contributions have gone from 8 to 50 to cover benefits, and that's a risk they're not happy with, and that's where CDC can potentially work. But it does all come back on CDC to sort of the comms and expectations, because we've almost seen it fall over a little bit in the Nordics, where effectively it works. It's a shared ambition until it has to go down, and then someone has to pick up the tab because the members kick up too much of a fuss. So yeah, no easy answers on this, but I think more of these conversations and questions are being raised, rather than I think very few are sat there now thinking we've cracked it with auto enrollment DC. That's the answer.
Yes, I think I'm interested in your comment about the valuation of the company reflecting pension scheme surpluses or deficits.
Yeah, starting to happen, but I think it very much depends on the equity analysts in question and lots of other things. But I mean, logically, it should be there.
Thank you.
Thanks very much. Now, Elspeth, aka Con Keating, you put a question out there about pension regulators. Would you like to actually convert that into a vocal statement?
Well, it's really me. My question really is, what is the regulator's real position? I can read the same warm words and nonsense that is being uttered in public by Nausicaa and other people, but it seems that the case officers are not in practice actually applying this. For example, I know of a scheme for a company that's been in existence for 180 years and is extremely solid financially. They've actually just been told that if they really are serious about running on, they need to conduct a covenant review, which is absolutely pointless. It's a complete waste of bloody money.
Yeah, so I think the regulator's position has shifted dramatically, and I'll put the slide up next on some of the quotes they've made on all of this. But I mean, look, you can see why the regulator is saying to the market, one of the risks trustees needs to think about is the risk that their sponsor's not there in the future. I would say for schemes with an ultra strong sponsor, that can be a pretty pragmatic exercise, and an external covenant advisor may not need to spend a huge amount of time working out that a very strong sponsor is fine to support the scheme. I guess devil's advocate, you might say, well, just because a business has been around for 180 years doesn't mean it will continue. Maybe it's reached the end of its useful time in the market. But
it's never been as financially strong as it is now.
Sure. So that sounds like, yes, there's a small annoyance there of having to spend any money to confirm what you already know, but you can sort of see from the regulator's point of view that having trustees take some advice on that situation is a sensible thing for them to push for. Hopefully that could be a fairly easy thing.
I don't believe it is. You see, I don't believe the pensions regulator is actually fully on board with a re-risking scenario of the pensions world.
Yeah. So, I mean, let me share it, because it's fascinating. Some of the statements in their guidance from about a month ago.
No, go.
Just for just for balance, I've picked out 3 of the interesting quotes, and there are lots of quotes in there which are less surprising and say the opposite, being frank. But some of the statements regulators now making, I mean, there's a section on effectively think about all your options. The first quote on this page is saying buy-ins may affect the provision of discretionary benefits. You should take a view as to whether the loss of potential benefits is sufficiently outweighed by any extra certainty of payment. So that is the regulator saying, you know, this thing that we've kind of said, they've always said we don't really mind what schemes end up doing, but we've lived through an environment where it's been pretty clear that if you're running a scheme and you pursue a buyout, that's a perfectly good thing to do. Thank you very much. But they're now saying, at least think about it. Are you giving up upside for members? So that's quite a different statement to what we've heard from regulator. The second one, lots of trustees I work with have taken some issue with. So the second one effectively says if you do your job and fund the scheme and it's now overfunded and you don't have a plan to do anything with that money, i.e. give it back to the members or the sponsor, that may indicate poor governance. So on the face of it, I think that's entirely logical, because if you're running a scheme and some are and you're 140 or 150% funded and you're sat there thinking that's fine, we're not going to do anything, maybe that is poor governance. But again, plenty of trustees are feeling, well, hang on a sec, we're kind of done our job here, we've got ourselves to full funding. So for you to sort of indicate that that's poor governance is a bit of an about turn. And then the other thing, into your direct question, Con, the regulator's saying, yes, new legislation on all this isn't coming for a couple of years, but you should all be thinking right now about how you could generate additional surplus so that you're ready and you've got more to release when you can. So on the face of it, in their guidance, they're saying, yeah, think about re-risking, crack on, and this is what you should be doing. Now, the question I ask and never get an answer to is, I'd love to see the track changes version of this guidance. Who's been editing it? Are any of them not from TPR? Who's left comments on some of these statements? Because we're in a world, we've got the regulator, we've got DWP, we've got Treasury, and my sense is Treasury have been calling the shots on this, and they are very keen to do anything to try and drive growth. So some of this might be coming more from that direction than possibly the sort of the stalwart TPR people.
Thanks, Steve.
That has got to be one of the comments we've had all year, Stephen. Thank you very much for that.
Brilliant. Now I know hands are raised. We've got JQ and William. I think JQ, you are actually first, but do you want to go first, or do you want to give way to William? What would you like to do, JQ?
I'll go first, because William won't be here till tomorrow, won't you, William? So that's fine. William, I love you. And that's Steve. Thank you very much. Just a couple of thoughts and comments. The that running on like an insurer versus running on full stop under LDI. It's worth noting that on a de-risked basis, the insurers probably get 30 to 35 basis point pickup over pension schemes. But CDI versus LDI, and it's because of illiquidity and so on. And that's a really important factor to throw into the mix. And I'm not a cheerleader for the insurers, but I'm a cheerleader for the value share, which Emma, you asking about sharing surplus out. I would encourage anyone to look at that, frankly, because it does change the game. The surplus gets shared with members and back with sponsors. The discretionary increase decisions are not made by the trustees anymore if they don't want to. And in particular, Steve, your point when you said giving £5,000 to members, my understanding to do with the unauthorised payments regime is that a pension scheme can't pay a lump sum easily to individuals.
Yeah.
I think the value share piece is very different. Because it's coming out of an insurance vehicle. And where that comes into play, in particular, is in the area of the share of surplus, because the critical thing is, if members are getting their payments up front, then the present value you mentioned should be a present utility value. And the utility value is much greater to individuals, and they are probably happy to take less because they're getting it now. We use discount rates in our industry of gilts +3. We should be using gilts +35 for a lot of people. It's way out of line. So we look at this from the perspective of the payee, not the recipient. And I think that perspective has to change when it comes to discretionary stuff in particular. And that's a fundamental shift that I think trustees, sponsors, advisors maybe not sponsors, trustees and advisors need to think about. I really do.
Yeah.
And I'll share with you one other thing. The single biggest thing that I was unaware of, well, one of many things I was unaware of until recently, was the means testing rules, where you give someone an increase and that gets disregarded one for one by because of pensions credit and housing benefit. So people think they've done a great job giving someone a pickup, and in that person's pocket, it goes in one pocket and it comes out of the other pocket from the government. Zero value, absolutely nothing. And again, these things are critical to get your arms around. I think we're able to get their arms and heads around for the purpose of the messaging and the design and the strategy. And I'm not sure we're anywhere near there yet. I think the high level stuff, Steve, is there, but I think this level of detail is really challenging in my experience and what I've seen recently.
Yep. And just on one of those points, we're continuing to push for the unauthorized payment issue to be fixed, because I think for so many schemes, in sharing with members is a tricky question. It gets really hard to make it fair. Members probably undervalue. If you write to members and say we're changing your LPI 03 benefit to an LPI 04 benefit, who gives a
Exactly.
Whereas if you write to members and say it's 2 weeks before Christmas, it's 500 quid. Hopefully we'll do the same again next year, but no promises. The value is completely different. Sponsors are much more up for it because you're not adding any risk. You're just distributing what you've got. So yeah, that's still on our list.
And it becomes productive capital, because at the moment
they go spend it. They're taxed on it. They go do things. Yeah, completely agree.
But also, frankly, if I give you £1,000 one-off, forget the tax calculation for a moment, versus £250 a year, the second has a much higher value. But if you've got credit card debt, that just pays the interest and you never get in front of it. There's so many factors that we just haven't thought about, because as an industry, we've dealt with trustees and sponsors. And that member piece has been a benefits design and structure that they're entitled to. But when it comes to discretion, all of these things come into play, I think.
Yep.
My personal opinion.
Agreed.
Thank you.
Okay, William.
Great
Keep it
stuff.
short and sweet, William. Well, short and sweet, like you.
Half as long as John. Anyway, that was great stuff, Steve. Terrific. I obviously agree with all the sentiments. I think maybe the thing at the moment is that the members and the trustees should be much more proactive, because everybody's happy to look at their situations again. Maybe if the trustees say what they would be prepared to do, if you would hard code in an increase of, let's say, 10% if there's a surplus subject to guardrails and all this kind of stuff, that looks singularly attractive. And the trustees have to look at that kind of thing. They can say, if I could get 10% more, given the analysis for the larger companies that you've been doing, that shows there is very little downside, suddenly I'm looking at a situation where I can go to the corporate and say, look, my downside is minimal, because I understand the gap between the FSCS and the PPF is actually quite small, and I can see there's an upside. Why can't we all agree on a structure which gets that inked in effectively in the Christmas bonus kind of culture, and you can overcome the unauthorized payment stuff already within the existing regulations? Not easy, but can be done. And I think suddenly the trustees should get on the front foot. I think they're the people now on the defensive all the time. Oh, woe is me, fiduciary duty. No. Your fiduciary duty is flipping over. You're going to have regret risk for not, as you referred to, for not doing stuff, as opposed to the things that you thought you'd done a great job. You haven't done a great job. So I think what a moment it is for the trustees to do something more interesting. And I think it can be done. It can be done. And it's really just, come on, let's recognize the downside risk for many is now minimal and the upside can be substantial. And that is sums you need to look at, not waffle. And when you look, just final point, look at that, you look at the stuff out of PIC and what they've been producing, they don't even refer in their analysis of why buying a good thing, don't even refer to discretionary increases. This is a moment in which that kind of culture within the life insurers really does need to be picked up. So I think perhaps the LCP story should be, come on, trustees, you can do more. Stop being so passive, be activists.
Yeah, and I think, you mentioned it, fiduciary duty is one question there, because depending on your legal advisor, as trustees, And many, I think, possibly wrongly, possibly rightly, think it's not really their job to chase for more benefits. Their job is to maximise the chance of what's being promised being paid. And I mean, just dipping back into the slides, in the cases we've worked on, I won't go through in detail with the time and lots of questions, but we spent a lot of time thinking about what could go wrong. And a lot of that naturally over the past 20 years has been driven by, if in 5 years' time we've done this deal, we've not done a buyout that everyone kind of thought we should, and the members end up losing out. And there were two tests we applied. Everyone on this call will know who the gent in the top left is. Frank Field, I think he's sat opposite Philip Green in this photo. So no one wants to be hauled into, why did you put stuff at risk when you didn't have to? And then the Daily Mail test as well, of sort of members who lose out, makes a pretty good story. But as you say, William, when do these hindsight tests flip round into you sold your pension scheme and the members could have had more? Now, I think still many trustees will feel completely relaxed about any risk that anyone's looking at them in 10 years' time and saying they made the wrong decision if they've taken full advice and they've done a transaction with a very well-regulated industry and everything else. But that is certainly becoming a question. And I guess
it was quite funny. I actually sat next to a senior figure at the Daily Mail quite recently, and they recognise there is an issue.
Yeah.
So I think there is a real risk for the trustee not to be complacent, because you really do need a jolly good file, and that's why we're fanatical about TAS 300. If your file isn't good enough on why you just gave it to the trustee, gave it to the passing life insurer, I think you are not only in legal terms, but in, hang on, what about what you should be doing? If there's an opportunity to get more for the members, to hide behind some really dubious, I think, legal interpretation of fiduciary duty, I think it's so easy to see that being overturned. As the number of times I've been jotting them down, the number of times that legal opinion has been overturned in recent times in this space is remarkable. And I think just to think that you're in a good position because you just gave it to a life insurer, I think is very rapidly going to become yesterday thinking.
Yeah. Yep. Could well do. And I completely agree with your sentiment.
Thanks. Thanks very much, William. Yeah, sorry. Steve, do you want to continue with the slideshow? I'm conscious of the time, and I know we've got Charles has got a hand raised, but you keep going, then we'll come to Charles.
Just very quickly, a couple of key points to leave you with. I mean, this is one of the cases that I think is quite interesting. Just to give you the bones of it, $1.5 billion. They were overfunded on buyout. Trustee wanted to buy out. We came in to advise the sponsor on what are your options. Thought quite hard, did all the risk analysis, ended up agreeing with the trustee what became a regrettable 50-page memorandum of understanding to defer any buyout transaction until 2040, reduced the investments a little bit, not lots. The company, very strong, global, massive compared to even this quite large scheme. They put in some external covenant support. So again, trustees applying that test to when I get, you know what trustees are like, when this all goes wrong, even though it's highly unlikely, and I get hauled up, you put in something that I can call on. So we put in place a surety bond so that it didn't cost the company very much because they're so strong, but the trustee can say, well, I've got some extra support I can call on. Members benefiting already. There's some ongoing accrual that's now continuing. They're getting pre-97 increases. Sponsors benefiting because all those costs have been paid for out surplus. And then when we get to a wind-up position, probably at some point or maybe ahead, any residual surplus is agreed to be shared 80-20 in favour of the sponsor. So it can be done. I think it took the right combination of attitudes in the rooms to be bothered to go through this, being frank, because the easy answer is just go secure it. That was everyone's job. So it took new people at the company who didn't know anything about DB pensions. I think that was probably the single biggest factor here. The guys in the States who knew nothing about DB pensions looked at it with that dispassionate economic lens. They were unencumbered by 20 years of problems. And they quite quickly formed a conclusion that why would we hand this off? We can do something better for everyone. But there are lots of cases where you don't have that perspective. And I guess being open, it took advisors who were willing to take this on and look at all the options and not take the easy route. Just quickly on investment strategy. I mean, this is how I'm viewing the world now, that we've been on a journey is schemes go from 80% funded to 100. They go from some investment risk to close a gap down to we better not mess this up. And I think risk appetites are now, in some cases, starting to go up the other side of this smile. And you rightly go on a journey when you're improving to sort of clamp down the risks of things changing. But as you get into a bit of a surplus, you actually start to realize that we've got quite a big buffer here against anything really going wrong. The other thing you get is where you're using hedging investments, you can stop allocating to those as you get into surplus, and therefore sort of as you allocate the money left over, it all starts to snowball a little bit. And heard it termed sort of when you reach escape velocity, sort of the assets escape from the liabilities. As you get enough of a buffer, you carry on investing vaguely sensibly, it all just starts to compound, and that's where the real potential value is. And I think just to round out, what has the regulator done? Won't go through all of this, but there's a fascinating point here on how much impact is this all going to have, because the government PR machine early in this year kept using the 160 billion number. That's all of the low dependency surpluses. Well, there's 160 billion of untapped. So they've done various things that I've listed on the left to see whether they can unlock some of that. They stopped short of what I thought was the most powerful option I've described to the minister as the shock and awe option of if you just write to everyone and say from next year members are protected by the PPF centrally fully and you're allowed to rely on that in your decision making. I thought that would have the most impact. The interesting question is the government's own economic assessment of the impact or impact assessment of these policies says it might be 11 billion of surplus released rather than the 160. So obviously there's quite a big gap there, to state the obvious. And I think one of the key factors bolded on the left is, whilst there are lots of new options that can be taken here, it requires trustees to decide to release a surplus back to their sponsor. And although you can make that possible and you can give guidance and you can clarify whatever you like, many trustees would say, why would I do that? It's not in my interests. So I think that's one of the big challenges. It's in that behavioural point. It's in that interpretation of fiduciary duty. But I think 11 billion's low. I mean, I've got one client who's going to do 1/10 of that as soon as the rules are live. So I'd be shocked if it's as low as 11 billion. But I don't think we'll get anywhere near 160 billion without some bigger, bolder changes still to come.
There are a couple of slides to go, and I don't think we're going to be able to get to all of them. Are you going to be kind and share these slides with those who want to see them, Steve?
Yeah, very happy to share, and yeah, 11:28. So any final questions, maybe?
Well, there is one from Charles. Do you want to ask it quickly?
Yes, thank you. And a fascinating travail through the pensionscape, Steve. Thank you for that. It seems to me that we've touched on different types of thinking. We've talked about pure economics. We've talked even about sort of emotional attitudes from the sponsor to the members. I wonder whether they all spring from rational choice theory and it all boils down to economics. There was some interesting research done by General Motors with a child psychologist from the then Czechoslovakia. And he said, there's emotional thinking, there is rational thinking, but there is also intuitive thinking, or almost like kind of daydreaming. And I, from my perspective, both as a sponsor and a trustee and involved in a small consultation group, I kind of, well, my guiding approach is intuitive, because the whole system is so complicated. In many parts, it's extremely contradictory, and it's in flux. And as the point has been well made so many times, you don't know where things are going to be 5 years hence, never mind 10 years hence, never mind 15. All I can say is, having, and I do listen, not least to the blessed Con, for which I am extremely grateful, and to others. I didn't go down LDI because I thought that it was another put-up job from the regulator, and it would massively overcharge us. At the present, my plan is to run on, to stick fairly majorly with equities, backed up with a strong covenant, or tending to be strong. It's because of that our deficit went down from over 2 million to 330. It's now down, or recently was down to about 30 grand. It nearly put us out of business twice. It's wiped out our profits, that and the levy, on at least 3 occasions, 3 years trading. So if I'm rational, I'm probably going to be tripped up next week, next month, next year, by the shifting sands. So I'll just finish there.
Nothing to add, Charles.
Thank you
Bless
very
you.
much. Okay, well, look, I thoroughly enjoyed the last hour, and I'm really grateful to all the contributors, but most of all to Steve. I hope you found it good, Steve. I know you've got a gig coming up in a couple of days' time up north, and we've kind of warmed you up, I hope.
Yeah, no, very happy to join this excellent discussion group. And yeah, I'll share the slides, but yeah, let me know if I can do anything else.
Have you got anything else to say, Steve?
No, I mean this is a good, healthy, open group that is very happy, and I think almost maybe naturally gravitates towards challenging what might have been considered normal. And that's my main call to action as I do the speaking circuit, as you reference, Henry. Just we are in different times, both in terms of schemes position and government attitude and everything else. So I think the most dangerous thing you can do is make a decision based on what you thought might be the right thing to do a while ago, and that's all I'm asking.
Well, you've got a thank you and a terrific session from Andy Young, and we don't often see that, so well done, mate.
Fantastic. Yeah,
Right.
that's brilliant. Steve, many thanks. Really appreciate that. If anybody wants the slides, please email me or Henry, and the video will be up
Go
today.
on my blog.
Or go on Henry's blog, indeed. Yeah, absolutely. Yeah. Henry blogs very occasionally, as most of you know. But Steve, thank you very much indeed. Really appreciate that. And let's, as usual, pray for peace in the East, peace in the Middle East. Lots of claps as well going on. Brilliant, Steve. Thank you very much. And yeah, please join us next week for another exciting episode of Pension Playpen. So yeah, really appreciate everybody's input, and enjoy the rest of your week, and be safe and try and stay out of the heat. And thanks for joining. See you soon. Cheers, Steve. Thanks a lot. Bye.
Thank you. Bye-bye.
Bye.